I want to bring in the Wall Street Journal's chief economics correspondent right now, John Hilsenrath. Also joining the conversation is Meyer. She is deputy head of economics at Bank of America Merrill Lynch, and we're happy to see you, Michelle.
Good to be here.
Thanks so much for joining us. John, let me kick this off with you. Your expectations for the jobs report and how important it is ahead of the Fed meeting.
Well, you know, I actually don't think it's that important because I think it would take a huge disappointment at this point to stop the Fed from raising rates next week. Janet Yellen has been signaling all week that they're on track to do it. You know, I think if we get a report which is along the lines that you just laid out, 200,000 payroll gains and a 5% unemployment rate, then they go in a week and a half.
Yeah, that's a good point. I mean, sort of baked in the cake at this point. Michelle, you're actually below estimates.
We are. We're modestly below. We're looking for 180,000 in terms of job creation. That's because we're going to see probably a payback from the exceptional job creation we had the last month of 271,000. But the trend is still going to be quite robust, and I very much agree with John. I think it's going to be hard for the jobs number this morning to stop the Fed from hiking interest rates.
And how bad would it have to be? How bad would it have to be?
Well, let me lay out. Dagen, let me lay out some numbers for you. Let's say we get 50,000 on payrolls, the 3-month average payroll gain, even with a 50,000 number today, is still over around 150,000. So that's a pretty bad number. And as Janet Yellen said yesterday, some number above 100,000 is actually enough to keep the unemployment rate coming down.
Yeah,
so it would have to be really soft.
It's already a foregone conclusion that they are going to raise rates because jobs numbers aren't the only numbers they're looking at. But what the jobs number will do will impact the pace and rate of what they increase rates. I mean, look at the last time the Fed raised interest rates from 2004 to 2006. They did it every single meeting for 17 meetings straight,
Did
right?
They do it every meeting?
Yeah, they went from 1% up to over 5%, right? So 5.25%.
So in a 2-year period, they raised rates 17 times.
And this gets back to what happened with the ECB yesterday. I mean, they're looking at the stronger dollar. They're looking at a lot of things that are happening in the market. So what they're going to see is if it's a bad number, they may raise rates at a slower pace.
And I think I think it's so much more than just that top line number too. I mean, we've talked about that, but Janet Yellen has said throughout the whole year they're really looking at wages and labor participation rate, and that's going to be a big thing when this report comes out. Yeah. Did we see more people enter back into the workforce? Are they feeling optimistic about the opportunity to participate?
Think we'll see any movement there, Michelle?
And I think that's something that Yellen actually talked a bit about yesterday. The idea that she still believes there is hidden slack in the labor market, looking at these broader measures of the unemployment rate, the U6 measure, marginally attached workers to the labor force. So it's been discouraging, the fact that the participation rate has remained stubbornly low. Yeah. But I think there is still hope out there that at a minimum it could stop falling and could start to stabilize. And that's another reason that you want to keep policy a little bit more accommodative. If you believe there's still capacity out there for people to join the labor market, you want to keep the economy growing as strong as it can for as long as it can.
You know, John, go ahead.
But the only way to do that is actually for the federal government to come in and actually stop having growth hampering initiatives like the Affordable Care Act, like all this overreach of regulation, right? That's how you remove slack.
That's not going to happen until
that's not going to happen. But the Fed can only do so much.
And you know what? That could really have a negative impact in 2016 because it will be the Obamacare will be fully implemented, and that means that employers will be impacted by having all of these additional costs for medical. We're seeing small businesses, even mid-sized businesses, and now it's going to be larger employers that won't be able to afford the health care. And
they're cutting benefits, though, because they're getting ready for the Cadillac tax.
Go ahead, John.
One point on the federal government side. We could talk all day long about the impact of regulations, and there's a lot of talk about how that's affected the willingness of people, of businesses to hire. But it's also the case that the headwinds coming from fiscal spending have receded a little bit, and we actually could get a little bit more out of that in the next year. In other words, a little bit more growth impetus, for instance, from this highway spending bill.
John, let me ask you about the ECB. Did the ECB miss the mark yesterday? What a reaction. Markets were really disappointed.
Well, Mario Draghi has developed this habit of telegraphing what he's going to do next, and the last time he moved in January, he over-delivered, so I think markets were expecting him to be fairly aggressive, and they didn't get it. The ECB is another reason why we were talking earlier about how the Fed is going to be moving slowly in this whole process. With the ECB and easing move, the Fed is very reluctant to tighten very aggressively. you know, I think we're going to be having the same conversation that we had in 2015 all over again in 2016. Well, when are they going to do it next? Not this meeting, not that meeting, not the next meeting.
Right.
It's going to be a long wait, I think, for the second move.
Expectations are where they are because he constantly comes out and says everything's on the table. We'll do whatever it takes.
Well, I actually find that irritating that investors are so dependent on the extremely loose money and extremely cheap money. They already have negative deposit rates, negative deposit rates in an environment that is not crisis.
And the main important,
suck it up.
Well, I don't know
if it's going to go away eventually.
I don't know if
central
Europe is,
banks managing expectations for investors, and that's what we saw yesterday. Draghi overpromised and underdelivered, but he doesn't have that much ammo to use in his arsenal. I mean, how many bonds can he buy? There's lack of liquidity in bonds for him to actually purchase, so he has to affect the deposit rate, which is already negative.
A lot of it also comes to the communication, kind of open mouth operations. One of the key ways,
open mouth, I like that. That's
one of the key ways that policy works is through forward guidance. So for Draghi and for other central bankers, it's not only what they actually deliver, it's what they're promising about what's coming. So, and I think that's what he was attempting to do is, look, we're putting additional accommodation, and we promise we're going to remain accommodative if the economy warrants it.
Real quick on the U.S. economy, Michelle, 2016, do you expect that we could go into a recession? This is the debate we're having every day because we know what's going on in the industrial side of the economy.
You're right. And when we listen to our analysts covering the industrials, they are so downbeat. But we're not in the recession camp. We still think that there's room for further expansion. You know, you're talking about low to mid 2% growth. It's not spectacular performance in the economy.
No, it's not.
But we don't think we're at the point where the business cycle is turning. There's still room to recover.
And the services economy is doing well.
The services economy is doing well. The housing market has room to recover. We're finally starting to see, fingers crossed, the recovery in wages, and that's going to lead to stronger consumer spending. So there's still a lot of positive stories that you can tell outside of the weakness in the industrial sector.
All right, Michelle, good to see you.
Good to see you.
Thanks so much, Michelle Meyer and John Hilsenrath. Always a pleasure. We'll see you soon, sir.